All right, so we are going to go through question 2 on homework 4. I'll start at the beginning. Well, at the beginning of that, I know that the question was about the latter part. We'll get to that, but I'm gonna start it out generally. I'm not going to use the specific um, 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 equilibrium numbers. That's not critical for answering that part of the question. We can do it with that, but that's not critical for explaining that. So let me go through that. So for everybody, I will share the screen first of all to explain the question, and then I'll switch to the document camera I have here and go through it. All right. I'm partly laying that out right now, so when the recording's available, then I'll be able to, well, I'm going to be able to sort of edit up to this point, and then the people watching will understand what we're talking about. Okay, so first of all, let me share the question. All right, so here's the homework. Here's homework number 4. Again, I will have solutions available. I had hoped to have them a little bit earlier in the week, but I said we're dealing with a bit of a crisis in the department, right? The moment that needed to get resolved so that students could get interaction with an instructor in the course. So due to a medical emergency. So here's the question. I'm sorry, you said question 2, right? Question 2D, right? Yes. I'm sorry, and I was making a comment about not using the numerical numbers. That was question number 1. Sorry about that. But my comment still stands that we'll do this generally. So one of the things that you should see first of all is that this is a question that's, that's related to stuff back from the previous exam. And remember, we said that the things build in this course and are cumulative. So what I mean by that is you see the uses of saving identity, a question about that in part B. And we can relate that to the question in part D, as in dog, as well. So let's just jump in, right? So what's the setup? So what's the setup for the problem? I know it's right there, but go ahead and go ahead and say it. What's the setup? What's the framing here?
Do you mean like that it's a...
What's the question? What's the question about?
It being a trade deficit.
Right. So trade deficits and rising trade deficits, right?
Yeah.
In 2018, 2019. I mean, this is real. That's not made up. As you know, I try to use stuff that's real in terms of what's going on in the economy. So that's the first part of the setup. Rising trade deficits, despite tariffs, taxes being imposed on goods imported from other countries. And those tariffs were intended to reduce our trade deficit, right? Tax on imported goods means people importing goods in the United States have to pay that tax, right? So it costs more. Not only do they have to get the goods into the US from China or Canada or Germany or wherever at whatever the price of the company that's selling it is, but they have to pay additional tax on that, right, to the US government. And that tax either the firms selling the product in the US then either have to sell it at a higher price, or their profits are going to get reduced because now they got to pay this tax as well. And that's exactly the point of a tariff, is then that makes US goods relatively more competitive because the price is going to probably go up for those imported goods now, and makes US goods relatively cheaper, right? So it's intended to help US businesses, right? US companies. So the commentator says, right, that it's not that you know the trade deficit didn't go down. We're still importing more than we're exporting. In fact, that difference is greater after the tariffs, and that the tax policies that were put in place by at that point President Trump were probably the cause of that. In other words, they kind of had the opposite effect that was intended by the tariff. Okay, so we're trying to analyze that. Like, does that make sense? Right. So let's start with I'm going to start with B actually. All right, the uses of saving identity, and then we'll use the graphs. So I'm going to switch. I'm going to change screens, share it. We've got to come out and go back in. Okay. All right. So now you're seeing this sheet paper. All right. So let's think about the uses of saving identity, right? So the uses of saving identity says that, right, private saving plus government saving, which is just national saving, right, is equal to desired or investment plus the current account. So in chapter 4, right? So we do this in chapter 4. We assume that the current account was 0, no trade, no exports, no imports. So the current account is 0 then, right? So this current account is essentially net exports, right? So those are 0. No exports, no imports. So in chapter 5, right, that's no longer true. It could be 0, but they could just match each other. But we have imports and exports. We have another country. Right. So what does the uses of saving identity tell us? I'm pulling up the question over to the other screen so I can see it. All right. What we know, well, so what happens if there are tax cuts? What's the first thing? So that's part of the setup for the question, right? Commentators talking about the tax policies, that those were likely to blame for bigger trade deficits, right? So here's the claim, right? To put it into the context of our model, but our uses of saving identity, right? That tax policies, tax cuts were leading to a reduction in our current account. Bigger negative numbers. The current account's negative. We import more than we export, right? Overall, in terms of goods and services. So the current account is negative already. And in this example, it's getting more negative, right? That's given to us. The trade deficit rose significantly. That's what it means, right? It means that's what that means in our language, right? So what do tax cuts do? Where's that going to come into play? In this uses of saving identity.
Tax cuts decrease government savings.
That's right. So government saving goes down. And the claim is that that leads to a reduction in the current account, right? That's the claim. That's the commentator's claim. What does economic theory tell us? That's the question. Well, the first place to do that is with this uses of saving identity. It's a really useful tool. So government saving goes down. First of all, what can we say about national saving? Probably.
It's also gone down.
And if that's the case, right now, we're going to put that down as a hypothesis. Right? That's a question, first of all. What has to be true for that to be the case? Because there are two things over here, right? I was just giving you the clue for that. What if people save their tax cuts?
Okay, private savings goes up.
It would go up, and it could theoretically completely offset the government saving going down. In that case, there's no impact on national saving, and no impact, at least on the combination over here, right? Because there's an equal sign there, right? So if nothing changes on the left of the equal sign, nothing changes overall on the right side. It doesn't say anything about the individual components over there, but overall. But why is that not likely the case, that people save their entire tax cut?
Because they're probably going to either invest it or spend it.
Well, investing would be saving. That's not spending on. So investing in financial investing.
Yeah, financial.
And we got to be really careful about that. How we use that term, because investment means capital for us, but financial investment, buying stocks and bonds, putting it in a retirement account, whatever. That would be that's all part of saving, private saving. So not spending on consumption is out of your income is saving. So. But we know that from economic theory, the marginal propensity to consume is generally, that would assume that marginal propensity to consume is zero. In other words, the additional spending out of an additional dollar of income is zero. That's probably not the case. It's also called Ricardian equivalence, we learned about earlier in the chapters earlier. But normally people spend some fraction, maybe 50, 60, 80%, depending on your income level, right? So some people in the economy may actually save it all. They don't need that money that they're now saving from a tax cut. Not as much money being taken out of their paychecks each week. Maybe they might save it, but there are going to be a bunch of people who are going to spend, right? All these seem like minor points, but they're actually important, because that helps us to explain, to get at this claim. We got to, that's part of it. That's an assumption. If you say that government saving goes down leads to national saving going down, that's an assumption that private saving isn't going up to offset that. Right? So it's an assumption. It's an assumption. And we have to make that claim. We have to say that, right? Otherwise, we don't know. So if that's true, and this is going down, then what's got to be true over here on this side?
It would also have to go down.
All right. So one or both must go down. Well, so so the reason we need to use the graphs ultimately is because this doesn't tell us anything, can't tell us anything about that. Which one? It tells us that one or both have to go down, but we don't know anything more than that. We just know that that total over here has to go down, if that's because there's an equal sign there, right? Just basic math. All right. So either investment's going to go down, the current account's going to go down, or both are going to go down. So is it plausible? Is the commentator's claim that a tax cut could lead to bigger trade deficits? Yay, nay?
What's the question? Are you saying that
So the claim that what this question is asking about is the claim by the commentator that the increased trade deficits are likely due to the fiscal policy of the government, bigger tax cuts. Is that plausible given the uses of saving identity?
Yes.
Yeah, that's what we just said. That's what we're saying. So this going down could mean that going down. Certainly plausible. It could be that just investment goes down. So let's think about that for a second, because that is going to get at the question for part D. That was originally what you were asking about. We can look at that even now without actually doing any graphs. Right? Back in chapter 4. So the question in part D is in dog, right? Is the effect of increases in budget deficits, right? We can generalize from this specific example. We can make broader generalizations. So the questions going from A to E in question 2 of the homework go from a very specific question and then broaden out the lens, right? To what can we say more generally? So in this case, in chapter 4, what was true? There was no CA. It was just that, right? So if we were in chapter 4, what could we say about the impact of bigger tax cuts? The bigger tax cuts lead to reduction in government saving, national saving, and the full amount of that impact has to be on investment, right? That's what that says. We okay with that? Right? If this goes, if this goes down by 100, then this side has to go down by 100, right? That's what it means to have that equal sign in between. Just to put a number there, you can put up whatever. Like sometimes people get bogged down in letters and not having numbers. Well, just put some numbers in there. Doesn't matter what the number is. Could be 10, could be 1,000,000, could be 100, could be 45. Doesn't matter. If the only place for that to go down in a closed economy, so what does that mean? That means if you have a closed economy and government spending goes down by 100, according to the uses of saving identity, investment has to go down by 100. Yeah? Am I good with that?
Yeah.
Okay. So that's why this is like the exit row in the airplane. I need to have like this verbal okay to that, right? Because I want to know that, because if that's not clear, then we need to talk about that. If in chapter 5, right, the current account, now we have another thing in there in the uses of saving identity. Current account's not equal to 0 necessarily. So now it's possible, it still could be the case that investment goes down by 100, right? But now it could be that investment goes down by 80 and the current account goes down by 20, right? Together, that equals the 100, right? So the first answer to part D in question 2, which is the effect of increases in budget deficits on investment bigger or smaller in the open economy model compared to the closed economy model? Why? That's the question. We can see it right here already, even before we do any graphing. Yes, it's probably going to be small. Not necessarily, but there's only one case where it's equal. It can never be bigger than the closed economy case. That is when that's equal, when that's not there. All right, S just equals I in that case. Desired saving equals desired investment in our curves, right? In the closed economy case. But now it might be divided up between a bigger budget deficit of $100 billion, right? Could be divided between a reduction in investment of 80 and a reduction in the current account. A bigger trade deficit all right, bigger trade deficit, right, of 20 or 70-30 or 99-1 or 50-50 or whatever, right? So I just need to, to get clarity about that. So are you clear about that? Like that's our first that's the first level answer to question 2D.
Now, are you saying that the budget deficits on investment would be bigger in the open economy?
No, absolutely the opposite, right? Why?
Okay, because it would equal each other in the
Yep.
closed
It's
economy.
100, goes down 100 here. Investment goes down by 100 here, it goes down by 80 there. Which
Mhm.
one's smaller? 80, right?
Yeah.
And we're going to come back and explain why that is. I'm going to come back. We're going to do the graph, and I'm going to go through and explain why. We'll be able to. We will be able to explain why that is, right? But using this uses of saving identity, it's really simple, right? There's just S equals I plus CA. I mean, that's all that uses of saving identity is. It's a really simple, equation. Like it's really powerful though, right? So it tells you already. It tells you the answer already, right? Not with certainty. It still could be so all this says, right? Just mathematically, all it says is if this side goes down by 100, right? Right. So it had to be, so earlier it had to be, let's say it was 200 equals 200, right? It goes down by 100. Now it's 100 equals, it has to be equal to 100. That has to be divided up. This decline of 100 has to be made up of either a decline in investment or decline in the current account. If there is no current account, closed economy case, then this has to equal 100, and that's 0. I mean, that's just by definition, right? But this could be 99-1, could be 80-20, it could be 20-80, right? But the point is, every other possibility, right, is less than 100. And there's a reason for that. So here's the simple reason. We can show this later. We'll show this in just a minute. The simple reason is, what does it mean for the current account to get bigger? We know this from chapter 5, the very beginning of chapter 5, the balance of payments. And there's a table that discusses this, and I mentioned that in the video, the overview for the chapter video, right? So here are different ways of saying the same thing. The current account goes down. Net exports go down. Trade deficit increases. The financial account increases. Borrowing, international borrowing increases. All 5 of those are say exactly the same thing according to the balance of payments. How do we know that? The current account plus the financial account equals 0. What's the financial account have to do with? That has to do with sales of assets. All right. So what actually is happening here? Why is that the case? The government, when it runs a bigger budget deficit, it has to, what does it do? It prints treasury bonds. It prints pieces of paper that says, okay, the $10,000 minimum is what they're denominated in actually. And those are treasury bonds, probably 10, 20, 30-year treasury bonds. It says, okay, we're going to sell these pieces of paper, like just literally on the open market. And we promise, the government, federal government, the United States, promises to pay the owner of this piece of paper. Let's say it was a 30-year bond for $10,000. The owner of this 30-year treasury bond, $10,000, 30 years from now. question is, how much are people willing to pay for that today? Well, it depends on a whole host of things, but there's a market for that. It's like asking, how much are people willing to pay for a share of GameStop today, or a share of Microsoft today, or like there's a market. Demand and supply determine that. There's a market for treasury bonds, right? So just another financial market traded in the open market. Who buys those? Not individuals typically, but banks and investment funds. Investment banks do. They hold part of their portfolio in that. Retirement accounts for the state of North Carolina, let's say. They hold part of their holdings, part of their wealth, and holding assets in terms of treasury bonds. So there are people in the market all the time, every day, every hour, every minute, buying and selling treasury bonds. So that price gets determined, and that determines what the interest rate is on those bonds, right? So, you buy it at $10,000 treasury bond at $8,000, and 30 years from now, you get $10,000. So it's a 25% interest rate over that 30 years, right? So a little, maybe around 1% per year, something like that. Well, that price gets determined in the demand supply in the market. Why is all that important? Okay, so step back from that. Bigger budget deficits, tax cuts, bigger budget deficits. They got to print more treasury bonds, put them out in the market. The question is, who's buying them? If you are a closed economy, it's only people in the United States that are going to be able to buy those, because there are no other countries in our model in that case, right? When there is increased supply, which is you're increasing the supply of treasury bonds, you increase the supply of anything, what happens? The price goes down, interest rates go up, they go in opposite directions, right? Higher interest rates lead to less investment. We know that because that's what the desired investment curve looks like. It increases the user cost of investment. Desired capital stock for firms goes down, profit maximizing firms. But if you have other countries, now you don't have to rely only on the savings of the people in your own country. You can have the you now have access to the savings in other countries, right? So what happens? The people in or governments or pension funds or whatever, banks in China or Canada or Germany or Mexico are also going to buy those US Treasury bonds because they're very safe assets. The US government's not going to default on them. They know that. It's like holding cash, kind of. They know that they'll be able to sell them. It's very liquid. There's a market, a well-established market for that. So they're very safe assets. They don't get as high a return as other things, but they're very safe, right? So we have access to more savings. So you don't have to rely only on the savings of the US. Now you got a bigger pool. And so the interest rate doesn't need to go up as much in order to get the money, get the money you need for pay for the budget deficit. Right? Interest rate doesn't go up as much, not as big an impact on investment, right? In the open economy. That's what's behind that. And that's what we're going to show. That's what we're going to show. All right. That in words is the idea. So now let's just work through this. So home country, foreign. I'm going to draw it so that the home country has a deficit to begin with, current account deficit. So the real interest rate, investment, saving, here's desired investment, desired saving, desired investment, desired saving, real interest rate in each country. All right, so we got to find where first of all, we got to find where the equilibrium world interest rate is. Right, the equilibrium happens when the current account in the home country is equal to minus the current account in the foreign country. Or the current account, remember the current account, right? So we can use the uses of saving identity, right? Saving equals investment plus the current account. Now, if we just bring that investment, saving, hold on. Nope. Sorry, somebody's at our front door here. My wife will get that. So subtract investment from both sides, saving minus investment, that equals the current account. All right. So any given real interest rate, that's that. So now let's think about that on our graph. That's actually what you use in problem number 1 to get to the equilibrium, to determine the equilibrium world interest rate. But we can do that in graphs. So at any given interest rate, the difference between saving and investment, the difference between these curves, right, is equal to the current account, right? So saving minus investment, that's the current account in the home, minus saving minus investment in the, desired saving in the foreign, right? So desired saving minus desired investment in the home country has to equal, let's take that out of there, the difference between investment and saving in the foreign country. What that means graphically is the difference between, at a given interest rate, the difference between these two lines here has to be equal and opposite of the difference between the two lines in the foreign country. So when does that happen? You have to kind of eyeball that. So let's pick this real interest rate, right? So could that be the equilibrium? No. Why not? There's no difference here. I minus S at that real interest rate is 0. But over here, it's not 0. It can't be equilibrium. In fact, there's more saving than there is desired investment in this country. So overall, in the whole world economy, there's a surplus of saving here that's not offset by a shortage of saving in this country. So what's going to happen? The interest rate's going to go down because there's a surplus. Could it go down to this level? It's easy to pick these numbers off, or these points off, to make the point, right? Could the real world interest rate be there? The answer is no. Same reasoning. The difference between saving and investment at that real interest rate in the foreign country is 0, but it's negative over here. It's not the same. So there's more desired investment than desired saving at that real world interest rate, right? If companies are wanting to borrow more money for new capital than saving that is available in the home country, but there's no excess saving over here, there's a shortage of saving relative to investment in the world. Interest rate's going to go up because there's a shortage. So it's got to be between those two. It's got to be between those two interest rates, right? Which would be the ones that would be happening if there was a closed economy. So it has to be where this line is about equal to that line. So about here, it doesn't have to be exactly halfway, but in this case, it looks like it's about that, right? So we're saying that distance right there has to be equal to that distance. And maybe I got it pretty close, okay? So that's our starting point. Call it R star. That's equilibrium. We haven't done anything to answer the question yet. That's a starting point. So to start with, here's how much saving there is in the foreign country. Here's how much investment there is in the foreign country at that interest rate R star. Here's how much investment there is in the US. And here's how much saving there is in the US to start with. What we're saying is that this difference right here, saving minus investment, has to be equal to investment minus saving in the other country, right? That's what we're saying, right? The reverse, it's a flip, right? Savings greater than investment here, investment's greater than saving here. That's got to be the case. I mean, it could be the other way around, depending how you draw the graphs, but I drew the graph such that, right, this one has a higher equilibrium real interest rate than this country, and that's going to lead to this country having a what? Why did I draw it that way? Because I want to match up with the problem, I want the current account to be what? Negative, right? in the homework question, it says the US has got a trade deficit. That means current accounts negative. For that to be true, investment's got to be greater than saving in equilibrium. Investments greater than saving in equilibrium. Okay. And that's how you get that, is by having the graphs look like this. So you have to think a little bit about how you draw the graphs for this to get to that situation. If you get equilibrium and that's the opposite, then that means that you, for example, what if I had drawn the graph so that the equilibrium real interest rate was much lower? Then we'd have the opposite. They'd end up with a trade surplus in equilibrium. So that's our starting point. So what did you tell me happens? All right, back here. What happens when there's a tax cut? So that national saving goes down, right? National saving goes down. So which market, which curve, which way, what happens? That's what we're doing. So which market? Well, we know it's a goods market. We know that, right? But is something going to happen in the home or the foreign? Budget deficits go up in the US due to tax cuts. What happens? Where do I start the analysis?
In the home country.
Yes. And so which market? Home country, home goods market, which curve?
Saving.
Yeah. Which way?
To the left.
To the left. Saving goes down. All right, that's what we said. Government saving goes down, national saving goes down. Where do we measure saving? On the horizontal axis. Down means less to the left, right? That's the way to think about that. You got to be careful about that. This is something that happens in principles of macroeconomics as well. So you could say, well, down, well, okay, that's a rightward shift or a downward shift. Like, no, don't think about up and down, because that's when we're measuring interest rates on the vertical axis. The down, right, lower national saving is measured on the horizontal axis. So lower means left. Okay. So leftward shift. All right. New supply curve. So it's as if this curve isn't there anymore. That's not the relevant curve anymore, right? It's gone essentially. Right? The new one is here after the tax cut. That's the curve. Okay. Which market, which curve, which way? Last part. What happens? What happens? Where do I go next? What do I need? What's the problem I need to figure out?
You have to adjust the form, or you have to adjust the real world interest rate.
Add another half sentence onto that.
And then
In order
to
figure out
the new deficit.
Well, yes, the new equilibrium.
Oh, okay. All right. Yeah, the new equilibrium.
Yeah. So I'm just making you really think through that. I mean, it's really important to sort of be that sort of specific about it, right? Because that, just to be clear, right? And so why does the real world? So we could just think about it like, well, I know that's got to be true. I know I got to do that just because that's what I know I need to do, right? But there are actual economic reasons why that happens, right? And it's important to understand that. Why does the real world interest rate? Why will it change? Because currently the real world interest rate is R0, or sorry, R star here, right? It used to be the case that saving minus investment was just equal to investment minus saving in the other country. Is that still the case? No, right? Because now this is the desired saving curve. So here's now, if interest rates didn't change, that's the level of saving, right? I mean, that's what it means to shift to the left. I mean, that's what it means. So now, before there's any change in the interest rate, what's true? There's a bigger difference between saving and investment in the home country. So that distance between saving and investment isn't equal to the opposite in the other country anymore. So what's actually happening, right? This distance over here represents the desire for borrowing, because there's not enough saving in the US country. That's what it means for there to be this difference between saving and investment. And there's not enough saving available. They make up for that by the excess saving over in the other country. They're going to invest, they're willing to lend, right? They're lending this to the home country, right? Because they have a surplus of saving, more saving than desired investment in that country, more dollars in banks than people want to borrow, for example, right? And they can lend that in the world market to the other country to essentially take over, you know, to close the gap between desired investment and the amount of saving available in the national saving available in the home country. But what's happened now? Desired savings gone down because of the tax cut, because of government saving going down. They're going to sell treasury bonds, and like that's going to suck up savings that's in the bank, that people in the bank, et cetera, because maybe they're going to make a higher return, et cetera. So I mean, so what's true? Now there's an imbalance. These two are not equal. So there's a shortage. Before, the surplus over here was just met by the shortage over here. Everything's in equilibrium. Now there's a greater shortage than there is a surplus over here. And that's going to drive the interest rate up, because there's a bigger gap here than there is here. Okay. When is the interest rate going to stop going up? When the difference between desired investment and desired saving is exactly offset by desired investment and saving over here, but the opposite. But it's not this curve anymore. That's the point. It's this dashed curve, red curve, but it's this dashed curve. So it's this curve and that curve that we got to pay attention to. So now we just I have to eyeball across, and maybe it's about right here. Right, here's the difference between desired saving and desired investment at that interest rate. We just keep this going across. And what we're saying is that is about the same as that distance. All right, this distance is equal to that distance. So at that interest rate, let's call it R star 2. We're right there. So what do we know so far? The real interest rate has gone up. The real world interest rate has gone up as a consequence of the bigger budget deficit in the US. In the end, what's happened to investment in the US? Right? It's gone down, right? So let's just go back for a second. Let's call this A, let's call this point B, let's call this C, let's call that D, right? So to begin with, AB, that distance, if we go back to like 9th grade geometry, is equal to CD, right? That distance is equal to that distance. It's the same as saying the things down below here. The new equilibrium, this is now A prime, B prime, C prime, and D prime. All right. So we started out with I0 and S0. That's A and B. I0, S0 over here. Where are we at now? So let's call this S. Oh, we have an S1 there. So let's just call it S2. That's fine. S2 and I1. All right. So what's happened in the home country? We know that the real world interest rate in the new equilibrium's gone up. What's true about the distance A prime, B prime? That has to be equal to C prime, D prime, right? Over here, that's what we said before. But what's true about A prime relative to A? Well, saving has gone down, investment's gone down, right? In the end. So in the home country, savings gone down, investment's gone down as a consequence of this budget deficit. In the foreign country, what's happened? Well, savings gone up and investment's gone down there too. This distance right here is the current account. So it's harder to see over here because both these points are moving, investment and saving, but it's easy to see over here. What's happened to the current account in the foreign country? What's true about the difference between C prime and D prime versus C and D?
It's bigger.
It's bigger. So the current account's gone up. So what has to be true over here? The current account had to have gone down. Right? Bigger trade deficit, bigger trade surplus. That has to be, since A prime B prime has to equal C prime D prime, right? And you're saying that's bigger than CD, then this has got to be bigger, but in a negative way than AB, right? So the current account has gone down over here, foreign country, current account's gone up. What does that mean? It means our net exports have gone down. Over here, net exports have gone up. What does that mean? Our financial account has gone up, right? Remember, these are all ways of saying the same thing. Our financial account has gone down over here. What does that mean? Financial accounts go up. These are dollar, remember, these are measuring dollar inflows. More dollar inflows into the US in terms of selling assets. Okay, so we are borrowing, our borrowing has gone up. Borrowing from other countries has gone up. Lending to other countries has gone up over here. Okay. So the financial account over here is the current account was positive. So financial account going down means it's more negative. It's a bigger negative number. It means more lending. That's the whole thing. Now, how do we answer what's the question? Now we can go back to where we were before, because now we really have the model to show us exactly what happens. If government saving goes down, national saving goes down in an open economy, that's going to lead to some reduction in both investment and the current account. Right? That's what we just saw here. That's what this shows. Saving goes down, or yes, national saving goes down, investment goes down, the current account goes down. Right? It's a mix of both. That's the point. That's what we're saying over here. It's a mix of both, right? Before, without that, right? It's just US saving that we have to rely on, and the reduction in saving is matched by a reduction in investment. So if we take us, so that's what that means. That's what this all means. There's less of an impact on investment in the open economy than there is in the closed economy. Why is that? It's because interest rates don't need to go up as far in the world, because now with higher interest rates, not only do you get more domestic saving to help finance the additional investment that the budget deficit, let me put it that way, sorry. So not only do you have more saving in the home country to finance the budget deficit, but you've got money extra saving at a higher interest rate from the foreign country. And so the interest rate doesn't need to go up as much to finance that bigger budget deficit, the treasury bonds that they print in order to pay for that. So so what is it? So what is it? So how does that relate to the last question on this homework question? It says, are rising trade deficits in the US a good or bad thing? So if we have rising trade debt, we can use this example. If rising trade deficits, right? That means more borrowing from other countries, right? Is that it? So then we can rephrase the question is more borrowing from other countries a good thing or a bad thing? And your first inclination, and so if now to go back to the very beginning of the question and the stem of this question, right? The perspective during the Trump administration, and it's not right or wrong necessarily, but the perspective was that trade deficits are bad. We want to do something about that to reduce the trade deficit, especially with China. And the way we're going to do that is we're going to put tariffs on imported goods, a whole bunch of them from many different countries. And that should lead to lower trade deficits. Well, not that by itself might happen, but not if you're also at the same time, you've unrelated to that, but you have a big tax cut that Congress puts through, passes, providing a lot of stimulus to the economy. That's a good thing in a sense, right? But it raises the budget deficit. And then what we see here is the increase in the budget deficit causes bigger trade deficits. And that is actually goes to part C in the question. And the discussion in chapter 5 about the idea of twin deficits. So what we mean by that is oftentimes, not always, but oftentimes, higher budget deficits lead to higher trade deficits. They don't have to by that uses of saving identity. It could just mean lower investment in new capital in the United States. So the question, is that a good thing or a bad thing? These trade deficits. Well, that's more borrowing from other countries. So the question is more borrowing from other countries a good thing or a bad thing? Well, that's exactly the same question that you could ask, we could ask, is borrowing from somebody for you to go to college a good thing or a bad thing? The answer is it depends, right? In your case, as a student, if you're borrowing more money, if you take out loans each year, you get bigger budget debt, personal budget deficits, essentially, right? Is that a good thing or a bad thing? Well, you don't like it because it's more debt you got to pay back. But why do you do it? Because the hope is that you graduate, you get good grades, and you get a much better job. You get much higher income than if you hadn't gone to college. And overall, you're better off. You can pay off the loans and still be way ahead, right? And have a higher standard of living than if you had not taken out the loans, not gone to college, and gotten some other job that didn't pay as much. However, if you take out the loan, student loans, and you just hang out kind of in college, go to the club, don't do homework, don't do well in classes, and don't graduate, well, now you've taken out the loan, you have the debt to pay back, but you don't have any higher income because you don't have the college degree and don't have as good a job. Well, that's a problem. That's not good. Depends what you do with the money that you borrow. If you use it to increase your human capital, in your case, all right, as a student, then yeah, it's perfectly fine. It can be perfectly fine. The same thing is true for the country as a whole. If the government is increasing its spending, and that's what leads to an increase in the budget deficit, and that's what leads to more borrowing from other countries, bigger trade deficits, the question is, what did you spend the money on? If you spend it on roads, bridges, education programs, things that increase the capital stock, increase technology, increase the capacity for higher income in the future in the country, higher GDP. Okay, you can, it's exactly the same. You can get higher income, higher taxes in the future from the higher real GDP without changing the tax rate. And you can pay off those 30-year bonds and whatnot, and you're fine. It's good. You put it to productive use. If you take the money, if you have bigger budget deficits and the money goes to things that don't increase the productive capacity of the economy, then you just have a bigger debt. And real GDP isn't necessarily higher than it would have been. That's a problem. It's exactly the same. The analogy is exact. So is it a good thing? A rising trade deficit is a good thing or a bad thing? Depends what we use the borrowed money for as a country. Are we putting it into investment? Are we putting it into consumption? So that's question number 2. That's a deep dive into question number 2, homework question number 2 on the homework. But it really encapsulates like everything in that chapter. So questions, comments. I know we're a little bit over time actually right now, but it's fine. I'm willing to go a little bit longer if you got questions or comments.
I have a question for 3. Do you want me to stick with 2?
Yeah, I do. Just want to make sure that, I mean, I know it was a lot. I know your brain is full probably with that, but if you got questions about this first, I want to make sure that I answer them.
Nope, you answered it. I thought I understood the question that you proposed, so part D, but I answered it kind of correctly, but not really, because I ended up saying something along the lines of like, I thought you were saying, is the deficit impact? Is the deficit impact on an open economy versus a closed economy?
Yeah, that's fine too.
Okay.
I mean, it depends how you answer it, but yeah, is the impact bigger or smaller? Well,
I said it doesn't have
on investment. It says in the question, it says, is the effect on investment bigger or smaller?
Mm-hmm.
So it's a very specific question.
Right.
Yeah. So I try to ask questions really specifically, not for any confusing purpose, actually quite the opposite, right? For clarity, so that there's not confusion about something. So it's a very specific, I try to ask the questions as specifically as possible. Yeah. Yeah. So I'll look at, we'll see that. That's on my agenda for this weekend, is to grade the homework, and I got to get the solutions out first. And yeah. So I'm gonna take that away. All right. Question 3. So
you could just explain a little bit where you say explain potential total factor productivity. I think it's,
yeah, and I can how A is determined.
Yes, please.
Yeah. So yeah, that's actually pretty, I mean, that straightforward. What I mean by that is like, yeah, we can answer that fairly quickly, I think. Yep. So right, we have this production function y equals a and I'll use the one that we're using, the Cobb-Douglas production function, and end of the 0.7, right? So that's our starting point, right? So let me say it conceptually, right? So we have data. I mean, we really do have data, right? I mean, in the US or any country, right? We have data on the capital stock. We can measure that. we actually have data on employment, right? So they're actual numbers for that, right? And then we have data on real GDP. Do we have data on total factor productivity? No, we don't. Like, that's part of the question. Like, well, what does it even mean, right? Like, how would we measure that? All right. So I'm gonna talk about this in two different ways. Well, so just conceptually, so so we have an equation with four variables, right? And if we know three of them, we can figure out the fourth one. Yeah.
Yes.
I mean, if I knew, if this was, I'll pick a really, well, no, yeah, if this was 10 and this was 20, and we knew that this was 100, then we could figure out A, because everything else, it would be something times A equals 100, right? In a spreadsheet, we could have numbers for and Y, and okay. We have numbers there, right? Real data, actual data, and and we'd have a formula to figure out A. What's that formula? So how would we get A by itself? Well, we just divide both sides by this stuff. So Y divided by K to the 0.3, N to the 0.7. That's equal to A, right? That's what that is, right?
Mm-hmm.
So if we have numbers for K, N, and Y, boom. We have A. What does that mean? It means A gets derived, total factor productivity. How is that determined? It's derived as what we can explain about GDP growth from capital and labor.
Okay. All right. I just wanted to make sure I wasn't missing anything.
But here's another way. Here's another way to think about that. Okay. Right? So if I come back up here, I'm gonna do it in a different way. If K and no, well, yeah. So if we know K and N, and A increase, and they're fixed right now. I'm just saying it that way. You'll see why in a second. So if K and N are fixed for a given amount of K and a given amount of N, a given amount of capital, and a given amount of workers to work with that capital in the economy, if A increases, what happens to Y?
Y increases.
Y increases, right? So what does that mean? For a given amount of capital and a given amount of labor, if total factor productivity increases, we get more real GDP. So the same amount of capital and labor can produce more real GDP if A increases. So what can do that? Technology, all right? That's why we oftentimes think about A as an increase in technology. It doesn't have to be increase in technology. It could be an increase in the way that the capital and labor are now working together, what software they have to work, AI, right? Machine learning, right? The same amount of capital and machines with new software can produce more stuff, for example, right? Oftentimes, A and K are related, then you get new capital and it includes new technology, but conceptually, it's stuff that helps the current amount of capital and the current amount of machines and software and whatnot in terms of dollar terms and employment produce more stuff. So what else could A have to do with? Education, right? Increases in education levels overall in the economy, literacy rates, right? In some countries, right? You increase literacy rates, the same workers working with the same capital can produce more stuff, because now you have more people being able to follow directions more easily and whatnot, and just a whole variety of things like that. So it's a whole bag of stuff. That's the point, is we can't really define what that is. We get that as a residual. That's the phrase. If you go back and look in chapter 6, and reread those first sections, you'll see that, and this will make even more sense now, right? That A is a residual after we've accounted for everything else. So the way it's actually done, take this equation and we take the log of both, natural log of both sides. I'm just gonna do this. So if like this bothers you in math wise, like just close your eyes. All right. And we take the log of the other side, a to the k to the 0.3, n to the 0.7, natural log of that. All right. So this becomes the ln of a plus the ln of k to the 0.3 plus the log of n to the 0.7. And so what you'll learn, are either of you in econometrics right now?
I am.
So this is a linear equation. So you actually take the logs, you take real GDP, you take the logs of it, put that. So now it's the log of that, log of that, log of that, right? And you actually, so this is like y equals alpha plus, and then you try to estimate beta 1 times x1 plus beta 2 times x2, but x2 is simply n, x1 is k, and you have data for that. This is the constant, right? And you're trying to estimate these parameters. When you actually do that,
Can we see your sheet?
oh, I'm sorry, you're right. I'm not sharing that one. Never mind. Sorry about that. I'm sharing my other screen. Sorry. Yep, absolutely. Thank you. Yep, sorry. Thank you. Thank you. Thank you. And you didn't see this stuff before when I was talking about then either. Yes. So if this is our equation, y equals a to the k to the 0.3, n to the 0.7, right? To go back and talk about that, right? If we know, I'm sorry about that. So if we know k and n, we have data for that. We have data for y. We can figure out a. It's just this. Okay. If so, where do these 0.3, where does this 0.3 and 0.7 come from? Where does it actually come from? It comes from econometric data or estimation, because if we take the log of this equation, natural logs of both sides, that's what we can do. This is where the math is helpful. So when you take the log of something, it's equal to the log of one thing that plus the log of that plus the log of that, right? And we can estimate that, right? Because we have data for k and n. So we just run a linear regression of y on k and n. Well, the logs of y and log of k and the log of n. And there are estimates that come out of that in ordinary least squares. In actually talk about this at the end of Econ 206, linear regression. And when you do that, this turns out to be about 0.3. That turns out to be about 0.7. When you estimate that, that's where those numbers come from. And then these are, we can estimate what the residuals are, and that's A. So it's what can't be explained by capital and labor. It's the level of, it's the GDP, real GDP, that can't be explained simply by different changes in levels of capital and labor in the economy.
Okay.
But that's what this says. That's what this says also. That's the same thing that says. This is just a linear version of that. How do we make that a linear version? We take natural logs of both sides. That's the math trick, right? And then that's why in econometrics, sometimes especially in, well, anytime you have a cup, it could be micro or macro. That's why sometimes you take the natural logs of the data. Like you could ask, like, why would you do that? It's to linearize it, to make it linear. Something that's not linear, make it linear. The way you do that is by taking natural logs. So that's that. I don't expect anybody to know that part, right? But I'm just saying, that's why I asked if you're in econometrics, that actually might be helpful to you to understand that. So, yeah.
Thank you.
Yeah. Yeah. It's actually called, so the part of the section of of chapter 6 that we didn't go over, actually there are 2 sections, right, was the solo growth model. We could have done that. It's just not, especially in a condensed semester. We lost a week because it's a 14-week semester rather than a 15-week semester this time, because of the way that because of COVID. Um, so that was one of the reasons for not doing that. It adds another model. It's okay, which is great, but it's related to chapters 4 and 5. But that model, it's called the Solow growth model. It's named after Robert Solow, because he's the one that he got the Nobel Prize for that, for understanding the growth model itself. But as part of that, the idea that this total factor productivity, it just you can't explain it. It's just what's left of the stuff that you can't explain. Now that's not very satisfying to an economist, actually. And that's why there's another section right after that. It's called endogenous growth theory. Is to try and explain, well, okay, that's great. And we can measure that as a residual after we've figured out the other part. It's what's left, right? And we just call it total factor productivity because it's the stuff that helps this stuff be more productive. What are those kinds of things? Technology, education, etc., right? New software. That's part of technology. But that's not very satisfying. So what actually predicts total factor productivity? And so more over the last 20 years or so, the work in growth theory area has been about what are the things that actually cause that to change, right? Instead of just saying, well, it's what's left. So what actually, do we have a theory for what causes that to change? And that's what the endogenous growth theory is about. And you can, as you can guess, things like education and that sort of thing. That's so anything that leads to more investment in those kinds of things should lead to increases in total factor productivity. So fiscal policies around that. So just an interesting sidebar. So Robert Solow, who was at MIT, so his son was a faculty member at the University of Iowa, where I did my PhD. He was a new PhD, relatively new PhD at the time. So so I knew him, and so Robert Solow would come to Iowa City, Iowa, where the University of Iowa was, which is where I did my PhD, and to visit his son and daughter-in-law, because that was also, they also had a child about actually the same time our first child was born. We were in the hospital together at the same time, and so the grandparents would come to see the grandchild, Robert Solow, and his wife, Dottie. She was an economist as well. And so we would have this, and he won the Nobel Prize at that time, right at that time. So like we would have this guy come for a week or two, come in to see his grandchild, but he'd just sort of be there in the department, and we could go talk with him and stuff. It was very cool. So yeah, it's a Solow growth model. That's what he won the Nobel Prize for. So yeah. Anyway, little tidbit there. All right. Any other questions?
I don't have any. Thank you.
All right. I will have this weekend some, well, on Sunday, as I said in the announcement yesterday, I'll have updated, sort of scheduling for next week. The exam will be Thursday, not Tuesday. Make sure that you're reading. There's no homework this time. There'll be a homework on chapters 8 and 9. Once we get to chapter 9, not next week, but the week after that, we'll spend 2 weeks on chapter 9. So, use this time to read that additional reading, which really does give an updated version of how the Federal Reserve actually carries out its monetary policy. That's related to chapter 7 because the way, even in the reading in that chapter, it hasn't fully caught up with that. That it still talks about changes in open market operations, changes in reserves as changing the money supply, which is what you learn in principles of macroeconomics yet, in the money market. And so changes in the money supply, that's how it carries out monetary policy. That's not exactly It's not exactly true. It doesn't change anything. Ultimately, the idea is that the Federal Reserve can set whatever interest rates it wants to, interest rate in the economy that it wants to through its monetary policy, but this doesn't happen exactly the way that it's portrayed in that chapter. But it's, you know, it's okay. That's an interesting sidebar as well, because one of the authors of your textbook is Ben Bernanke, who was the chair of the Federal Reserve a decade ago. It's just that textbooks, and that's part of the point behind the piece by Scott Walla and the other author whose name I'm escaping. I know Scott, but is that textbooks just haven't caught up with that yet. So that's part of the reason for including that. So use this time to read those the extra readings. The two readings, they're related. There's duplication in essence, but that'll be a good thing actually in this case. They're telling the same story, not different. All right.
Okay, thank you so much.
All right. I
Have a good
will.
one.